In July 2026, BYD sold more than 420,000 vehicles worldwide. Its overseas sales reached a record more than 180,000 vehicles, more than double the figure from a year earlier. By almost any measure, this looked like a major global breakthrough. But was BYD's overseas success making the company stronger, or pushing it into a transformation that would be far more expensive and difficult than its rise in China? BYD had built its position in China by making electric and plug-in hybrid vehicles affordable to millions of ordinary buyers. That strategy created enormous scale, lowered production costs, and allowed the company to launch new models quickly. But in July 2026, BYD sold about 239,000 vehicles inside China, roughly 9% fewer than a year earlier. The broader market was also slowing. Passenger vehicle sales fell by about 20.9% during July 2026, as demand weakened and some incentives became less generous. The pressure did not come from weaker demand alone. Geely, Chery, Leapmotor, and other manufacturers now offer increasingly capable electric and hybrid vehicles at similar prices. New models arrive faster, discounts are deeper, and technology moves down the market more quickly. BYD has offered entry-level models priced below 70,000 yuan, or roughly $10,300, while bringing driver assistance features into the same part of the market. Buyers receive more equipment for less money, while manufacturers spend more and leave less room on each sale. BYD's scale still provides purchasing power, manufacturing efficiency, and cost advantages that many rivals cannot match. But those advantages are harder to protect when an entire market is cutting prices and adding features at the same time. The effect is visible in BYD's financial results. In 2025, BYD generated nearly 804 billion yuan in revenue, but net profit fell by 19%, its first annual profit decline in 4 years. In the first quarter of 2026, revenue fell by almost 12%, while net profit dropped by more than 55%. Sales were slowing, but profitability was deteriorating much faster. That helps explain why overseas markets have become so important. BYD's financial results suggest that its overseas automotive business is considerably more profitable than its increasingly competitive domestic operation. In 2025, the gross margin of its overseas automotive and related products business was about 28%, compared with roughly 17% in China. Higher overseas prices can help offset domestic discounting and support further growth. But overseas growth brings costs and risks of its own. Tariffs can weaken BYD's price advantage. Safety and emission standards require local testing and certification. Governments may also demand local factories, local employment, and locally produced components before the company can compete at scale. Even after a vehicle enters a market, it still needs dealers, spare parts, repairs, software support, financing, and products adapted to local expectations. This means that overseas expansion cannot remain an export story forever. The more successful BYD becomes abroad, the more pressure it faces to build vehicles, and the system around those vehicles, closer to its customers. That transition is already underway. Chinese-made BYD electric vehicles entering the European Union face tariffs of about 27%. The market remains open, but one of BYD's strongest advantages, price, has been weakened. BYD's response is to localize production. Its new factory in Hungary is expected to begin production in late 2026, while the company has already established manufacturing operations in Thailand and Brazil. But building a factory abroad is not the same as reproducing the system that made BYD successful in China. Inside China, BYD operates within a dense network of battery plants, component suppliers, engineering teams, logistics providers, and vehicle factories. Components can move quickly, suppliers can respond to design changes, and production problems can often be solved with less delay. A new overseas factory may not have the same support around it. Local suppliers may lack the necessary scale, cost, speed, or technical experience. Some components may still need to come from China, while new plants require trained workers, stable processes, regulatory approval, and experienced local management. Production is only part of the challenge. As BYD sells more vehicles abroad, it must also build dealer networks, spare parts systems, repair services, software support, and customer trust. Exporting cars can create rapid sales growth. Building the industrial and commercial system behind those cars takes much longer. And overseas localization is only one of several expensive transformations BYD is attempting at the same time. BYD is also trying to improve its profitability by moving beyond the affordable mass market. Its portfolio now extends from the mainstream Dynasty and Ocean ranges to newer premium brands such as Denza, Fengchengbao, and Yangwang. But the company still depends overwhelmingly on its mass-market models. Its higher-end brands are growing, yet they remain small beside the core business that produced BYD's enormous scale. Premium vehicles may offer better margins, but building a premium brand requires more than adding technology and raising prices. It depends on distinctive design, consistent quality, strong retail and service, and years of customer trust. BYD has already proved that it can make capable vehicles affordable to millions of buyers. The harder question is whether it can persuade customers to value the brand for more than price. That challenge also makes continued technological leadership increasingly important. For years, vertical integration gave BYD an advantage that few automakers could match. The company did not simply assemble vehicles. It produced many of the most important systems inside them, including batteries, electric motors, power electronics, semiconductors, and other major components. That control helped reduce costs, manage supply shortages, and develop vehicles faster than many traditional manufacturers. But competitors are improving. Their batteries are becoming better. Their software is becoming more capable. Their vehicle platforms and manufacturing systems are becoming faster and more efficient. BYD must therefore continue investing simply to protect the advantages it already has. The company is developing another generation of battery technology and expanding its fast-charging network. These investments may strengthen its products, but they must be funded while domestic competition is reducing the profit available from each vehicle sold. BYD is therefore spending heavily on three fronts at once. It is building factories and commercial networks abroad. It is trying to establish premium brands. And it is investing to maintain its technological lead. All three strategies may be necessary, but all three draw on the same cash flow, engineering talent, management attention, and time. BYD has already proved that it can build vehicles at a scale and cost few companies can match, and sell them far beyond China. But exporting cars is easier than rebuilding the supplier networks, production systems, service capabilities, and brand trust behind them. A vehicle can cross an ocean in several weeks. An industrial advantage can take years to reproduce. The question is no longer whether BYD can become a global seller. It is whether the system that made BYD successful in China can travel with it.